For most people, this barely registered as news. A few banks quietly paused silver sales, no emergency announcements, no breaking headlines, no public explanation that made sense. Just a short message to customers: silver is temporarily unavailable. But when banks stop selling something that people are actively trying to buy, it's never random. Banks do not walk away from profit, unless risk has quietly become more dangerous than reward. And that's where the story really begins, because this is not about a temporary inventory issue. It's not about a broken supply truck or a delayed shipment. This is about a deeper structural shift in the silver market that banks understand very well, and most of the public doesn't. Tonight, we're going to explain what actually changed, why banks pulled back at this exact moment, how this decision connects to global supply stress, and what it quietly signals about the future of the silver market and the broader financial system. This is a story of shrinking inventories, rising industrial pressure, fragile paper markets, and an asset that is no longer behaving the way banks were trained to expect. Why banks ever sold silver in the first place? Banks do not sell silver for decoration. They sell it because, for decades, physical silver was treated as a low-risk, high-volume retail product. Customers buy coins and bars. Banks earn a spread. The metal is easily replaced through wholesale suppliers. Price fluctuations are hedged in futures markets. The system only works if three things remain true. Physical silver must be easy to source. The paper hedging market must remain liquid. Price must remain relatively stable. For a long time, all three conditions existed. Silver flowed steadily from mines. Industrial demand was predictable. Investment demand came and went in cycles. Paper markets easily absorbed risk. But over the last few years, each of those foundations has weakened. The industrial demand shock most people missed. The biggest driver behind today's silver shortage is not investors. It is industry. Silver is now one of the most critical materials in the modern economy. It is used in solar panels, electric vehicles, power grids, data centers, medical equipment, telecommunications, advanced electronics. As renewable energy expanded, silver demand surged. Solar panels alone now consume a massive share of annual silver production. Electric vehicles use significantly more silver than traditional cars. High-speed digital infrastructure depends on silver's unmatched connectivity. This demand is not optional. It is built into energy policy, infrastructure spending, and technology development. At the same time, global silver mining has struggled to grow. Many silver mines are actually byproducts of copper and zinc mining. When those metals slow down, silver supply slows down with them. This created a structural gap. Demand kept growing. Supply did not. For a while, above-ground stockpiles covered the difference. Vaults provided the illusion of abundance. Prices stayed calm. Banks kept selling. The system appeared healthy. But stockpiles are not production. They are storage. And storage always runs out eventually. What changed inside the vaults? One of the most important indicators in precious metals markets is how much metal sits inside official vaults and how quickly it moves. As industrial users increased their long-term contracts, more silver quietly left the tradable system. That metal went into manufacturing supply chains where it does not return to the market in bar form. At the same time, large investors began favoring physical ownership over paper claims. That shifted even more metal into long-term private storage. As these withdrawals accumulated, something subtle happened. The amount of silver available for immediate delivery fell to levels that made banks uncomfortable. Banks rely on predictable replenishment. When wholesale suppliers cannot guarantee consistent physical supply at stable prices, retail sales become risky. This is where many banks quietly reassess their exposure. The hidden risk banks are avoiding. When a bank sells you physical silver, it usually hedges its price exposure using futures contracts. That way, if prices move while inventory is in transit, the bank is protected. This model assumes that futures contracts always represent a reliable source of physical delivery or accurate price discovery. But when physical supply becomes tight, futures markets start to behave in unusual ways. Delivery becomes harder to guarantee. Premiums rise above futures prices. Spot prices disconnect from long-dated contracts. Liquidity thins during periods of stress. At that point, hedging becomes less reliable. For a bank, this is dangerous for several reasons. If futures cannot be trusted to reflect true physical pricing, risk models break. If physical supply cannot be sourced when needed, the bank faces delivery risk. If volatility becomes extreme, regulatory capital requirements rise. In simple terms, silver stops being a routine retail product and becomes a risk exposure. Banks do not like unpredictable risk in non-core businesses, so they step back. Quietly. Why the timing matters. Banks did not slow silver sales during times of low demand or falling interest. They pulled back while public interest was rising. That is the opposite of normal retail behavior. Retailers stop selling when supply uncertainty increases, replacement cost becomes unpredictable, risk of price gaps becomes high. Regulatory risk increases. All of these conditions now exist in the silver market at the same time. At the same moment, industrial demand remains locked in. Global silver deficits continue. Physical premiums remain elevated. Outflows from trading vaults persist. In that environment, banks face a risk asymmetry. They can gain modest profit from selling silver, but they face potentially large losses if price volatility or supply disruption strikes during a transaction window. From a risk management perspective, that is no longer worth it. The paper market versus physical reality. The modern silver market is dominated by paper trading. Futures contracts, exchange-traded products, and derivatives generate massive trading volume each day. But physical silver does not actually change hands at that scale. The system only works if most traders are content settling in cash. The moment large numbers of participants demand physical delivery, stress appears. Banks understand this dynamic better than anyone. When they see physical inventories tightening while paper volume remains elevated, they recognize a dangerous imbalance. In such conditions, paper prices can look stable, but physical availability can deteriorate rapidly. And when the two diverge too far, repricing happens suddenly. Banks do not like sudden repricing events. They prefer slow, orderly markets where risk can be measured and transferred. Silver no longer fits that description. Why this is not about a temporary shortage. Temporary shortages happen when a factory shuts down or shipping lanes are disrupted. This situation is different. The current silver imbalance is driven by long-term energy transition policies, global electrification, infrastructure modernization, strategic stockpiling, mining production constraints, declining above-ground inventories. None of these forces will reverse quickly. Even if prices rise, new mining supply takes years to come online. Exploration, permitting, financing, and construction operate on long timelines. Industrial demand, on the other hand, is already contracted years in advance. That means the supply side cannot quickly rescue the market. Banks are not reacting to a temporary problem. They are reacting to a structural one. The confidence problem. Markets are not powered by metal alone. They are powered by confidence. Confidence that supply will be available when needed, contracts will be honored, prices reflect real conditions. Liquidity will exist in times of stress. Once confidence weakens, behavior shifts rapidly. Large institutions do not announce when they lose confidence. They simply adjust their exposure. They reduce inventory. They suspend certain products. They tighten terms. They quietly step away from activities that no longer fit their risk profile. To the public, this looks like a simple sales suspension. To risk managers, it is a clear signal of rising uncertainty. The energy transition effect. One of the least discussed aspects of this issue is how closely silver is now tied to national energy strategy. Modern energy systems rely heavily on silver for efficiency, durability, and conductivity. As power grids become more digital and decentralized, silver usage increases rather than decreases. This connects silver to a much larger economic machine. Government subsidies for renewable energy, federal infrastructure programs, long-term utility expansion, data center growth, national security technology. When a metal becomes embedded in national strategy, its demand stops being cyclical and becomes structural. Banks track these shifts carefully. They understand that when strategic demand meets constrained supply, routine market behavior can break. Why banks prefer to exit? Early banks are not designed to detect crises at the same time as the public. They are designed to exit before the public notices. They turn away from crowded risks. They reduce activity before headlines change. They prioritize balance sheet stability over short-term retail profit. Stopping silver sales early achieves several goals. It eliminates inventory risk. It avoids sudden replacement cost spikes. It restricts exposure to price volatility. It minimizes regulatory capital requirements tied to commodity risk. In simple terms, banks are protecting themselves from a market that is becoming harder to model. And when banks find a market difficult to model, they do not stay exposed. The wider financial context. This silver story does not exist in isolation. It is unfolding inside a global system marked by high sovereign debt levels, expanding money supply, persistent inflation pressure, rising geopolitical fragmentation, reshoring of supply chains, commodity nationalism. In such an environment, tangible resources regain importance. Money can be created quickly. Technology can be copied, but raw materials remain finite. This shifts power toward physical assets. Banks, institutions built on financial intermediation, become cautious when the system starts favoring physical scarcity over paper abundance. What this means for the market. When banks step away from retail silver sales, several important things happen. First, access becomes more fragmented. Instead of sourcing through large financial institutions, buyers must rely more heavily on private dealers and specialized wholesalers. Second, pricing becomes less uniform. Without banks acting as large, steady sellers, spreads widen and premiums fluctuate more dramatically. Third, volatility increases. Fewer large, stabilizing participants mean the market reacts more sharply to changes in demand and supply. Fourth, physical ownership becomes more clearly separated from paper exposure. This increases the distinction between financial contracts and real metal. These are not signs of a calm, stable market. They are signs of a market transitioning into a different phase. 3 critical takeaways. First takeaway, banks stopped selling silver because physical supply has become less predictable, while industrial and strategic demand continues to rise. This increases replacement risk in a way retail profit cannot justify. Second takeaway, the paper-silver market no longer perfectly reflects physical conditions. As that disconnect grows, hedging becomes less reliable and risk increases for institutions that rely on it. Third takeaway, silver has shifted from a routine retail precious metal into a strategically sensitive material tied to energy, infrastructure, and national planning. Markets behave differently when that happens. The deeper warning, financial systems work best when paper claims and physical reality stay aligned. The moment paper grows faster than the physical foundation beneath it, stress accumulates silently. It accumulates in vault inventories, in delivery delays, in rising premiums, in institutional behavior that no one announces publicly. Banks did not stop selling silver because demand disappeared. They stopped because certainty disappeared. And markets built on uncertainty do not unwind slowly. They reset suddenly. Final thought. To most people, the suspension of silver sales looks like a minor operational decision. In reality, it reflects a deeper truth. The world is moving into an era where physical resources matter more than financial abstraction. Energy systems, digital infrastructure, and national resilience depend on metals that cannot be printed or replaced by policy. Silver is one of those metals. Banks understand that shift. They always move first, and they rarely explain why. By the time the reason becomes obvious to everyone else, the market structure has already changed. If you want to continue understanding how real resources quietly shape money, markets, and power behind the headlines, stay connected here. Because what is happening to silver is not an isolated event. It is part of a much larger transition that is only just beginning.